Shares of Levi Strauss are ripping at the seams this morning after the retailer took a hit from a decline in US sales, down 22% year over year, and slashed its full-year profit outlook as it battles a difficult consumer landscape and climbs back from high inventory levels. Harmit Singh, Levi Strauss Co CFO Chief Growth Officer, joins me now this morning. Appreciate you taking the time to join us this morning, Harmit. I mean, we're seeing investors really honing in on... Thank you. We're seeing investors honing in on this full-year guidance, and especially on that softer wholesale aspect as well. Break down the reaction that you're seeing from investors and how justified you think it is.
Sure. First, thanks for having me. A bit of the backdrop. You know, we came into the year expecting this year to be a tale of two halves, with the first half a lot weaker than the second half, essentially because we were lapping strong growth from a year ago. We were implementing an ERP, and commodities, cotton in the first half was pretty high. And a tale of two worlds, with the Western world slightly softer, the Eastern world and Latin America, fairly strong, and a tale of two channels. Our direct-to-consumer business, which is our stores and e-commerce, and the best expression of the brand, strong, with the wholesale business largely weaker. As we exit the first half, a couple of things. We have delivered on our, quarter two commitments and our largely first half commitments. We were up, we were flat to a year ago, but up 10% relative to 19. The headwinds, like the ERP is implemented, commodity pressures have abated, and the second half is being set up much stronger. As well as our direct-to-consumer business is up, double-digit on top of double-digit growth from a year ago. Going back to the question about the full-year guidance, as we exit the first half, we have grown market share in the U.S. Men's is up, women's, where we were, number 3 a couple of years ago, we're number 1, and we're taking actions to address U.S. wholesale. We're taking some surgical, price reduction on a handful of fits. Our supply chain has got a lot more efficient, and inventory levels have come down dramatically. And, we said we'll end the year with inventory levels below last year levels. And so we're basically setting up, 23 and the second half, where we will grow mid-single digit and exit 23 in a much stronger position and laying the foundation for a strong 24.
We know that a lot of investors, they were looking at that data, but they were also a little bit concerned about that net loss for the quarter of 1.6 million. Obviously, something we hadn't seen since pre-pandemic there. So in terms of the long play then with direct-to-consumer, is that still going to be the committed focus there versus any more reliance on third-party sellers?
Yeah, as we've expressed strategically, our direct-to-consumer business is today about, a little over 40% of our business. It was, half this a decade ago when Chip and I joined. And our slated goal is for this business to be the majority of the business going forward. We have great retail customers, and so the company is going to be a hybrid company from a channel perspective and actually grow distribution with both customers. But the direct-to-consumer businesses represents the full expression of the brand. The chambray shirts that I'm wearing, the denim bottoms, a non-denim business, etc. If you go to our stores, you find, a head-to-toe look, as well as, the interaction and engagement with store staff, the tailor shop, etc. is how, why we believe the consumer engages a lot better in our direct-to-consumer business, as well as our e-commerce business, which was up 20 odd percent this year and is still underpenetrated. So to your point, and in the U.S., Rachel, our DTC business is still strong. So it's a tale of, two channels in the U.S. Our direct-to-consumer business fairly strong, U.S. wholesale business weak, and we're taking actions, as I said, to actually address that so that we exit 2023 with a more stable U.S. wholesale business and a continued strong direct-to-consumer business. Our international business, which is outside the U.S., is really strong. It grew, 10% if you adjust for Russia. And that business is now close to, 60% of our business and growing. And our view is, that will continue to grow. Between DTC and international, there are higher growth and higher gross margin business. So, from our perspective, definitely impact the structural economics of the company positively.
And I want to also ask you about the state of the consumer. Consumers, they're looking for value plays, and we're seeing that across the board here. And we're looking at Levi cutting prices for roughly 10% of U.S. wholesale styles in Tier 3 wholesale accounts. What about some of the other models, perhaps on the DTC side or with the 501 denim models as well? Can we expect to see more price cutting there?
Yeah. So the answer is no in terms of price cutting across what we call our core and premium expression of the brand. So just a few facts on the price reductions, which were targeted and again against a handful of fits. They were largely driven by the fact that we're seeing the value conscious consumers earning less than 100,000. Become a lot more price sensitive. And, as we thought about actions, we said there are a handful of fits where we have taken pricing over the last couple of years. And, we need to adjust that. But as you think of the U.S. landscape, we have over 120 fits. We are taking pricing actions on 6, so it's about 5%. Wholesale is over 60 odd fits, and we're taking actions on 6 with basically not touching the majority of a line. They provide great value to the consumers. We do brand equity studies on a regular basis, and price value equation for the Levi's brand, both here in the U.S. and outside the U.S., comes out fairly strong. And that is because we deliver quality products, the relevant products, both for him and her, and that's being borne out by the market share growth. And so our view is these actions, including ensuring that when our customers orders, they get the product on their floor. And so when the consumer walks into a retailer, he or she gets the product. And we're seeing a major lift as the stockouts abate. And I think that's going to be a big play in terms of how we drive improved execution in the U.S. wholesale business in the second half of the year.
And what do you think is going to be the biggest selling point for Levi going forward? As you mentioned, sort of, tight spending here, still waiting for some of those inventory issues to work themselves out as well. What do you think is going to be the biggest selling point for Levi for the second half of the year?
Having the right product on the floor, a lot of newness. You talked about 501. We're celebrating the 150th anniversary, of the launch of the 501. We created jeans and denim, and we're celebrating that. And so you're going to see, a lot of newness on the 501 in the second half, especially as we gear up for back to school and the holiday season. The second is improved execution. When somebody walks into our store, you get the product you're looking for, you get the size, and that's really improving our fill rates from that perspective. And then with a slight adjustment on prices, again, a better price value equation. So if he or she really wants, either a denim top or a denim bottom or a non-denim product, they're going to come and shop at Levi's. And we have other brands, Rachel. We have Beyond Yoga, which is, doing really well. Dockers, doing well. And so, our perspective is we want to own a higher share of your closet and become the best apparel company in the world. And so we're gearing around, meeting that long-term mission or vision.
I've never been brave enough to do the whole Canadian tuxedo, the denim on denim for the shirt and the jeans. Maybe I'll give it a try. A big thank you for joining us this morning on Yahoo Finance. Harmit Singh, Levi Strauss CFO and Chief Growth Officer. Thank you so much.